We've now got a panel of leading experts from the MENA region where there's a wealth of experience in impact investment, early investment, startup investment. And I'm delighted to hand over the mic to Ara Fernezian. Ara.
Thank you, Andrew. Good afternoon. I welcome you all to our exciting panel discussion on the future of impact investing in the MENA region. Our panelists today have a vast financial, asset management, strategic consultancy, and investment experiences in emerging markets as well as impact. I'm pleased to introduce to you Sonia Weymuller, founding partner at VentureSouq VSQ, a GCC-based VC focused on early-stage technology ventures both regionally and globally, with a portfolio of over 180 companies. In addition, Sonia is the partner lead for the VSQ Conscious Collective, a thematic fund that brings together regional mission-driven investors and family offices aligned in motives and purpose. Previously, she worked in global corporations such as Microsoft, Viacom, and Turner in London and Dubai. Happy to introduce as well Dr. Bhaskar Dasgupta, the Associate Director of Business Development at ADGM, focusing on financial services across emerging markets and Europe. He's responsible for overseeing the development of the banking, asset management, private banking sectors, including key areas such as crypto assets, fintech, reinsurance, sustainable finance. Prior to joining ADGM in 2019, he was the CEO of UK Export Finance at the Department of International Trade, and as well as senior roles in firms such as HSBC, ABN AMRO, Citigroup, and PwC. I would like to welcome as well Medea Nocentini, co-founder of companies creating Change C3, a UAE-based organization fostering social enterprise in the MENA region. She's also the CEO of Global Ventures, a UAE-based growth stage venture capital firm focused on investing in emerging markets. Medea previously served as a senior executive role at AW Rostamani Group, Booz Allen Hamilton, serving clients across Europe, the United States, and the Middle East. Now, our panel discussion will deep dive on the tremendous growing attention of mainstream global investors in impact investing, with its current global market size estimated at $700 billion, with 20% growth each year. The last 12 months, COVID-19 crisis has accelerated further impact investing, driven by healthcare, sustainable agriculture, and education sectors. Despite these growing trends, the MENA sector only represents 2 to 5% of the global investment market. We will discuss and share insights on what is driving these global trends, why the MENA lags behind, and how MENA capital markets can attract impact funds to accelerate the impact-driven entrepreneurship ecosystem. I would like to ask now our panelists, starting by Sonia, what is impact investing and how is it different from philanthropy, and what is their business model? Why are we witnessing such a growth globally? Is it driven by COVID, pressure from the global community and consumers? What are the key drivers?
Thank you, Ara. I think it's a great question. I think each of us will have kind of a different nuance kind of answer to it as well. So when we set out to launch the Conscious Collective last year, it's something we've been wanting to do for a while, but we actually didn't feel like this market was quite ready yet. The venture capital ecosystem here is already quite nascent, and we felt that if you added that impact layer, it kind of added to the confusion for investors who are just starting to get their heads around venture capital as an asset class. That said, when we set out to launch it last year, the way we kind of went about it was to focus on supporting entrepreneurs and ventures that are harnessing the power of technology to address societal, economic, and environmental challenges. So that's kind of the macro layer of what we're focused on. Within that kind of informed and fed into the sectors that we chose to focus on. So we focus on ag and food tech, financial inclusion, environmental tech, and health tech specifically. So somewhat of a generalist approach. because we're also new players in the space. I did work with Acumen in a past life, so I had that experience. But the offering really with something like Conscious Collective, for example, it's not philanthropy, so it's not a check writing exercise. We look at deals commercially exactly the same way that VentureSouq always looks at deals. We're just hyper-focused on specific subsectors, and we're focused on channeling some of the MENA, that's the money that sits here in MENA, towards these sectors that we feel some of which are underserved. So it is different from philanthropy. There is a financial return. The other question that you asked around what do we look for? We really look for companies where the impact is embedded in the DNA of the company, so that as the company kind of scales commercially, the impact scales alongside with it. And that's very important to us. And so that's kind of how we came up with our kind of overall theory of change around how we wanted to approach this, understanding that if you look at the spectrum of impact investing, you have all kinds of different players. Even someone like Acumen, for example, has their approach. Our approach is kind of different. And then you have kind of traditional venture capitalists who look at deals purely commercially and maybe care less about the impact. Although we're seeing a change now, which we can talk more about later.
Bhaskar, do you share the same definition on the same subject?
So look, I mean, I have to admit that I've got several hats on this particular question. Obviously, if you look at the textbook definition, it's basically any investing which obviously has a financial return. But besides that, you need to have a clear, measurable ESG impact as well. Now, that's what I would call as the textbook definition. Great. The challenge that comes up is, what does a regulator do about it? And traditionally, how ADGM has always operated upon is we do not comment on how and where you invest. What our concern is the person who's looking after the money, whether what you have said is what you are doing, and the market is working appropriately. So that's the first angle purely from a regulatory perspective. The second piece that comes up is for us to actually look at the overall ecosystem. And we have VCs over here. We also have got other funds. Now, let me give you a very challenging response to this. For example, one of Mubadala's funds that was set up, Catalyst, it invested in an agricultural firm which is going to farm salmon in the UAE. Now, from a social perspective, it's okay by increasing employment. It's going to be helping towards the food security of the country. But it's a sovereign wealth fund. Is it doing impact investing? You could argue yes. You could argue, well, maybe not. But then from the longer term perspective, I think almost every investment is on the path to become impact investing. The chances that you can be sitting in an ivory tower or in one of the skyscrapers saying, the only thing that I'm worried about is the return, those days are gone. You have to worry about who's investing, where are you investing. Your portfolio companies will actually demand that. More importantly, your employees will start asking, are you looking at the gender agenda? Are you looking at the social piece? Let's do something where there is sense in me applying. Those days of robber barons and financial institutions, they're gone, if not on the way out.
That's so inspiring, Bhaskar. I mean, what is your point of view, Medea? And I want to know more, what type of startup ventures can be qualified as impact as well?
Absolutely. And I cannot agree more with Dr. Bhaskar, because there is a very different take on what makes business sense on one side, which I call FIC value versus fin value. So a lot of investors realized, in particular during the pandemic, that companies that bring FIC value to the communities around them, they're actually more resilient, they have more chances to survive longer, and they bring a bigger return in the long run. And so there is definitely an increased interest from the traditional investors that look at these kind of companies with different eye. But traditional investors will still put return on investment before impact, because that's what they have signed for with their own LPs, with their own investors. So it's important to distinguish between traditional investors looking at the opportunity of doing good and being happy that there is an impact down the line, versus the ones that put impact first and then they make sure that there is a return down the line. And there is a lot of different way of looking at it. The asset classes you include in this definition are so different. You have, again, impact funds that make zero return. They look at impact and they just want to get the money back to be able to reinvest in more social impact projects. There are the impact investors that look at a return of 4 to 5%, which is actually close to the average. There is a recent GIN report that shows an average 5.8% return when it comes to impact investors globally. Again, if you look at what's included there, it's a lot of it's a big variance between all the different investors. So, and interestingly enough, even foundations and philanthropic initiatives are now looking at putting their money in initiatives that are sustainable, so that their philanthropic effort can last longer, if you wish. So there is a convergence between all those investors or philanthropists towards a very similar model that eventually can be also combined, so that with the same investment, a philanthropist gets zero returns but a lot of impact. The venture capital get a 10% return and will be happy about seeing an impact down the line, and everybody benefit. The important element that I think we still miss in the region is the ability to combine those kind of funds sources. You need multiple licenses to be able to get donation or charitable funds, and as well as investments, which is not what happens in other jurisdictions. So I think that ultimate goal of being able to combine the different sources of funding will change the destiny of a lot of entrepreneurs that are trying to do good out there.
Thank you for sharing these valuable insights. Now, in simple words, for all startups or entrepreneurs who are listening to us today, and the ones who are looking for raising funds, what qualifies them to become attractive to impact investors or investors in general?
From an entrepreneur perspective, it's paramount that the mission is aligned with the business model, as Sonia was touching upon before, so that it's a virtuous cycle and there is no compromise to be made down the line, that the theory of change is strong. And third, even more important than the first two, is to measure impact from the beginning and make sure that those data are captured properly and the impact is proven.
So, how do you measure impact? Is there a common understanding or a global benchmark for both entrepreneurs and investors to follow?
I think it's a mix of everything. I definitely think that there's an acceleration due to COVID. I think historically there's like a lot of echo chambers. I think, Medea, Dr. Bhaskar and I are probably part of the same echo chamber in the way that we view the world. But I think COVID was kind of there to just put it in front of everyone's eyes. We need to invest more in healthcare. We need to invest more in the environment. We need to invest more in mental health. We need to invest more in education. And so for us, even when we built Conscious Collective, and we launched it in March, by the way, 2020, it was literally like, not intentional that it was at the same time as COVID. But I think in hindsight, it actually helped strengthen our narrative of why we're doing what we're doing as well in the end. So I think impact investing has been around for a while. I mean, we talked earlier about the UK. I mean, the UK has been a pioneer in the space for over 20 years now. It definitely has not been the case in this region. I think Medea has done an amazing job with C3 over the years. I think finally it's your time, Medea, in terms of people really listening from the more kind of traditional sector, whereas before maybe it was a bit more of a challenge. So I think there's a few reasons why. Obviously, COVID is one, but also when you see kind of, the head of BlackRock with his annual letter pointing to ESG, 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 I think for players in this space who kind of often look outwardly to other players, kind of well-recognized players, they're like, okay, BlackRock is saying this. Maybe this is something we should start looking into right now. And this is why we're seeing all these LinkedIn posts from, not going to name names, but from some major sovereign wealth institutions in the region hiring for like director of ESG and director of impact, etc. Right? So we're kind of at that tipping point, which is really exciting. I've actually got goosebumps, which is actually really exciting for us on this panel of people finally understanding why that this is the future of investing. Whether you like it or not, this is the future of investing, what Dr. Bhaskar was saying earlier. So I think we'll see more of this. I think the other kind of point that's worth noting is that I think LPs are also being educated in this space as well. And so once we start seeing LPs demand of the funds that they're investing into, that they start reporting on the impact metrics, then this will funnel down to the entrepreneurs as well, right? So it's going to create that virtuous cycle of kind of accountability when it comes to impact reporting, etc. I do agree with what Medea was saying earlier. What do you look for? You look for a company that's tracking their impact from the get-go and not as a nice to have, kind of, because it seems to appeal to one investor that's looking at the business. I do think one challenge, and I think this is again is where C3 is going to come into play, is around that. Like, how do we educate the entrepreneurs on reporting their impact as well? So we're trying to do that on the investor side. So that's why we launched the Conscious Investor Fellowship last year, to educate and nurture the next generation of mission-driven investors coming out of this region. But we also need to make sure that the entrepreneurs are similarly being educated on how to report on their impact as well moving forward.
Medea, in your experience, how we know and differentiate whether this particular venture is actually for good? Like take AI or biotech driven, for example. How can we be so certain that its purpose won't change over time?
That's a very easy question. Thank you, Ara. I will go from the top. I will use a top-bottom approach. So when it comes to regulators, country, if not international institutions, should help setting, and I will look up to them if we agree on the basic principles globally. And locally, we translate those principles in a way that is relevant for the communities in the country we live. I would really be very grateful to see at least certain principles agreed at a very high level, because individually it's a very difficult choice to make when it comes to what's good and what's bad, and the devil is in the details. We all agree that certain things are good or certain things are bad, but having a framework that clearly defines that, I think, will be helpful, and that will translate in regulations and policies and so forth. When it comes to investors, frankly, it's a choice of the investor, and the parameters of what is impact, what is return, how to balance the two. It's really in the hands of the GPs, I would say, if it's a venture capital firm, or the partners, if it's a different type of investment vehicle. They need to set the strategy. The LPs or the funds of funds will buy into that strategy, and that's a little bit their choice. And hence, I agree with Bhaskar when he says, as ADGM, we don't enter in the impact measurement details of each of the investor that comes to ADGM. When it comes to entrepreneurs, it's a slightly different story. I do think it's helpful for them to have training, and that's actually what C3 focus on. We help entrepreneurs look at impact measurement in a practical way, because what you have out there at the moment is actually very helpful perhaps for big corporations, but it requires a lot of resources and a lot of money to be done properly. Even just SROI, we had one entrepreneur back in the days, Palestine, that went and took the first step in getting the SROI certification. They got it. They were the first one in the MENA region. It took 9 months of work. Great, but not replicable at a larger scale for startups. So what we do, we help them be strategic and be lean about finding the right KPIs and measuring them in a practical way. We have more and more elements and frameworks that we can use. There is one that just yesterday night I was checking, and it's called Iris Plus. It's always part of Gene. They have created a database of relevant KPIs by sector. Now it seems to be more user-friendly, if you wish. So we'll explore that for our entrepreneurs. It's good to have a reference, if you see what I mean. And that reference is still not there. It should be an international one with certain variances by region eventually.
I'll just add to that as a segue. So we've been using Iris Plus on our impact measurement for our ICs, for our investment memos, and then we layer on additional impact KPIs that may not be reflected by Iris Plus. And then to answer your question around kind of the use cases for technology, good or bad, ultimately it has to do with the intentionality of the founder, right? This is why, for us at least, I'm sure Medea is the same. Like, we spend an insane amount of time getting to know the founder and understanding what the motivation is behind starting this business. And I think that's something that traditional investors maybe don't do enough of. Yes, you'll know that your founder is married, has 2 kids, etc. But then most of the conversations will be around kind of the business. For me, what's more interesting is actually understanding how this business fits within that founder's personal journey. Because what we've seen even at VentureSouq, if we look at some of the companies that have not done so well amongst our portfolio, oftentimes it's not because the founder doesn't have the relevant experience or the idea is not a great one. It's just a question of timing. This is not the right time for that founder to be focusing on this business right now. And so I think, I've said this on other panels, I think it's really important for both investors and entrepreneurs, actually, in general, impact or not, to take the time to self-reflect and understand why you're doing what you're doing. Why are you investing in this, or why are you starting this company? Because that's going to help you kind of better understand yourself and ultimately be a better conscious leader for your organization. Again, whether you're an investor or a founder. And so I think talking about, and Dr. Bhaskar alluded to this earlier, but talking and kind of keeping in mind that intentionality is key when it comes to this space is very important. And so I guess that's kind of my view on it. So if you take the time to get to know the founder and understand what motivates him or her, then I think you'll have a pretty good gut feel as to whether or not that founder is going to use that technology for good or bad purposes, right? So I guess that's my view on your question around use cases.
Can I add one comment to that, Ara? And I cannot agree more. Its intention is the driver of each enterprise out there. When it comes to impact, it's even more relevant. And when our social entrepreneurs or entrepreneurs come to C3 and ask, should I get a certification or not? Because in some cases could help them actually attract a certain type of investments or certain type of clients. It's always a question of what's your intention down the line, what is your strategy, because as soon as you go to that final goal and you get certified, that means a lot of different things, and it has a lot of different implications. For example, you need to lock in the constitutional documents of the company, the mission, that could attract a certain type of investors and clients, but could also impair the fundraising ability with certain investors as well. So it really depends on the long-term strategy and the ultimate why that the entrepreneur has, at the beginning of the journey, that really drives what an entrepreneur will do and how deep will be their work in certain areas of the business.
Thank you. Now, in the last couple of years, I kept hearing from many investors that impact investing is a myth or a PR exercise and it won't generate returns for investors too. So what's your take on this? I mean, is there some good experience or evidence that it actually works from both ends, investors and startups alike? Something that you can share with us today?
I'll give a couple of perspectives, if I may. Look, I mean, you might have seen the announcements from MAN, who are talking about a social accelerator, and quite a lot of startups, for example, in the area of people of determination, they came up and they had indicators which was measuring the success. The second piece that I'm going to talk about is that, as I was very briefly mentioning when we were preparing, is that quite a lot of my family offices are coming into here. And this is built into the culture. If you look at the Quranic injunctions of niyat, Sonia, you were talking about, intentionality. It is nothing new here. If you look at the Quranic, and actually it's in the Talmud as well, you are going to be measured by your intentions. So what I'm trying to say is measurement doesn't always need to be quantitative, which it has, but there's also an art behind it. And you can recognize it. We tend to try and box everything, which I think at this moment of huge tumult, COVID-19, demand and supply shocks, I think you need to rely a bit more on the goodness of people to recognize that what you are investing in and what you are doing is good.
But people's intention might change as well due to greed, for example, or other factors. So how do you manage that?
That's why we meet our people every month. As Eisenhower said, trust but verify. I'm sure the ladies also would agree that they meet their founders very regularly.
I'll add to, I will box things and answer your question. And actually, Medea referred to this earlier as well when she talked about, when you look at the performance amidst COVID, for example, ESG funds did end up outperforming S&P 500 during the first half of 2020. So you want proof in the pudding, there's that. Secondly, I would say, when I look, for example, at impact VC specifically coming out of the West, there are a couple of them that are releasing reports. So Kapoor Capital released their report around how their impact fund ended up outperforming traditional VC industry benchmarks. Social Impact Capital as well has numbers. We're not talking about 4 to 5% IRRs. We're talking about 20 to 25% IRRs. That's what we're aiming for at VentureSouq as well with Conscious Collective. You mentioned earlier the fact that there's more funds being channeled into the space. We're at over $700 billion now of assets under management with regards to the space. So we're seeing SPACs. Everyone's talking about the Angami SPAC, right? We're seeing SPACs now also popping up, almost $19 billion worth of money of impact SPACs for 90 companies in the impact space. So again, back to what I said earlier, this is happening, guys. so jump on the bandwagon with us. Welcome.
Yeah. When you look at the average that was just released, the average return on investment, it was just released by Gene recently. It's a 5.8% return on investment, which is not bad on average. I'm sure there are impact investors that get a 10% and others that get a 0 by design. So it's providing returns. And I want to add one more point. It's also a way to diversify risk, because higher return brings higher risk. When we invest in companies that are probably slower in bringing the return, they also create a risk mitigation in a big portfolio. It's very interesting to look out at diversification of portfolios, bring longer term return as well. And again, when you have JP Morgan launching a few years ago, by the way, launching an impact investment fund, I'm not sure they do it as a CSR initiative. They probably have in their pipeline an important strategy, which is asset diversification longer term.
We still have 2 questions before the end of our session, and I would like to ask you, although we tapped into this earlier, which impact sectors and type of ventures are growing and why, and which startup stage are more attractive to investors?
So I could give it a shot in terms of where we are seeing both the growth of funds and the startups. So the areas that I think it very interestingly overlaps with what, for example, the other funds here are representing. So agri-tech is good, edu-tech is good. We are seeing quite a lot of growth in future energy, environmental pieces. These are pretty fast growing areas.
I mean, I think we've talked about this before. So like clean tech, health tech, ed tech, definitely one. If you were to ask me, I'm going to twist your question a little bit, Ara. If you were to ask me what's the sector I'm most excited about, is actually supply chain technology. So we actually made one investment last year in a company in the US in this space. I think we're seeing a lot of this in the news, obviously, corporates being held accountable for example, again, not to name names, one corporation was found out that their toilet paper contributes to deforestation. There was a shareholder rebellion that happened around this. And so I think that's an area that I personally am excited to look more into. We're diligencing a second company now in this space. I think, interestingly, it hasn't hit this region yet. So I think stay tuned. But eventually, I think it will hit this region. I think all corporates in the region as well will start being held accountable for their supply chain and the transparency around that. So that's my answer.
So our last question for all of you, what do you say for sector agnostic or traditional investors and entrepreneurs?
To investors, I will just recommend to look at the biggest opportunities that are all impactful. And again, we talked about healthcare, we talked about education. Those are interesting because of the importance for the consumer, for the community, for all the players and stakeholders, but also because they are still fairly traditional. The big players have a transformation agenda that will accelerate, and investors could support that transformation with fueling innovation outside those big corporates and then finding a very good and interesting exit down the line. So I do think no matter from which standpoint it's looked at, pandemic or no pandemic, it's very interesting when it comes to gaps and what innovation can do for those gaps. And when it comes to entrepreneurs, I would just say, continue to do what you're doing. There are so many impactful entrepreneurs out there already. They might not have been in the spotlight in the past few years, but I would say is just your moment, in particular when it comes to impact entrepreneurs. I'm very excited about the conjunction we are in, because all the work that some of the stakeholders, in particular, a lot of entrepreneurs have done in the past few years, it's actually coming to fruition, and it's their moment.
I have the same advice actually for traditional investors, aspiring impact investors, traditional entrepreneurs, and aspiring impact entrepreneurs, which is take time to self-reflect on your intentions and your motivations, whether it be in terms of crafting your investment strategy, whether it be in terms of crafting your company strategy. Take that time to really kind of listen to yourself as to why, and understanding why you're doing what you're doing. Because that will translate into the narrative that you're trying to sell, for example, if you're an entrepreneur, but also it'll kind of give you the opportunity to start thinking about what you want as an investor and the type of change that you want to see. Because it's very nice to say, oh, like, you know, I care about education. But that's very kind of generalistic statement to make. Like, what can you do if you have access to capital to actually change the playing field when it comes to educational technology, for example? And what's the best way you can add value other than just a check size? So I think I'm just a big proponent in general of people taking the time to sit with themselves and understand their own motivations. I don't think we do it enough as a species. So that would be my my main area of advice.
Okay, from my side, of course, we are focusing very heavily on the institutional side because, well, that's what where we are coming from. It's like one eye on the cat and one eye on the fish. So from the institutional side, absolutely, I agree with Sonia and Medea that, you know, this is the way. This has to be the way. And you can see that the progressive people are starting to latch on to this particular mechanism of investing. On the entrepreneur side, absolutely, there's, I mean, I can't actually add anything more than what Medea and Sonia said. The way we operate, the way the economic system works, has to be measured on a way which is much more than just numbers. You have to do good.
Our session came to an end, and I wish we had more time. I thank Medea, Bhaskar, and Sonia for this inspiring conversation and valuable insights. And I want to thank everyone who joined us today.